In this video, I'm going to teach you the three most important things to do with supply and demand trading, in my opinion. Those three things are the basics, which we'll do very quickly. Secondly, fresh orders. And lastly, decision points. So let's get into it.
We pop out at your party, I'm with the gang, and there's gonna be a robbery. So tuck your chain, I'm a killer, girl, I'm sorry.
Oh, for some context, I've been trading supply and demand since 2015. I used to run an educational group where I've taught supply and demand trading to hundreds of people. Just to add some context to that, in case you might be thinking, who the hell is this guy and what can he tell me? Might help. Okay, so this is called a demand zone. That's the supply zone. Demand zone is characterized by a rallying price, a consolidation, and then another rallying price. A supply zone is characterized by a drop in price, a consolidation, and a further drop. That's basically the technicals of it. Now, the key bit of information for supply zones and demand zones is the consolidation. You have to wait until that consolidation is broken even to the upside or the downside before you can characterize it. Basically, what it represents is an equilibrium in buyers and sellers. It means that they're kind of evenly matched if you looked at it as sort of a battle. And then once one of them doesn't have enough money, the other wins, and then you get a breakout in price. Kind of an easy analogy to look at it. I don't know if it actually works like that, but it makes the most sense to me when I explain it that way. So I kind of run with that. Let's go and look on the charts where things are a little bit cleaner. I haven't just seen my scribbles on the blackboard. Now, I don't want to give a masterclass on the basics of supply and demand trading. You can probably find that anywhere on YouTube. Actually, you can find it everywhere on YouTube. It's been around for ages. Loads of people trade this way. I'm just here to talk about the nuances of it and from the experience that I've gained, what little things I look at, and hopefully that can make a little bit more sense to you. So let's look at the second most important thing, price recency, or fresh orders, as I like to call it. If you're looking at the logic of supply and demand, i.e. at this last level of consolidation, that's where there were more buyers and sellers. This is the most recent thing that happened. It's where buyers took place to break resistance on the previous swing. So if you see here, we have two swings over, another consolidation area of supply, and another consolidation area of demand. So the way I look at it is each zone represents some sort of value. There's going to be a certain amount of money that has taken place within that zone, whether it's in demand or whether it's in supply. For example, it could be that there was $800 million of buying versus $500 million of selling. So once that $500 million of selling has gone, then there are $300 million of buying left to take place, and that pushes price up. So that has invalidated the previous level. The only reason I will look at two swings over is for our third point, which we'll get to in a moment. But essentially, the most recent buying that has taken place on this swing down has broken through not only the area of consolidation where the selling took place to create this zone, but has also been enough buying to completely relieve all of the selling on the previous swing. So as price comes down to it, I'm not going to look two swings over because all those orders have been consumed. The information we have from the previous swing over is that it met an area of resistance and it broke through it. So the valid information we need is just here on this swing. So the concept of fresh orders is that if price has moved away violently from a zone, it's likely that there are still orders that haven't been filled at that level. So on a retest of it, those orders will fill and then continue price in the previous direction because obviously it needs to retrace back down to it. Again, it's just a story that I've been told. I like it. I subscribe to that trail of thought. It makes sense to me. And again, it probably will be reflected in the order book. Now, if you've been in any penny stocks or if you've been in crypto like me and you go into a coin or a stock with low market cap and you go in with a decent sized bid, you're not going to get the exact price for all of your entire order. It's the exact same thing, the exact same principle in supply and demand zone trading, but it's just going to be on a bigger scale. It's banks, it's funds, that sort of thing. So when I'm looking for a level, for a reaction, or to get a bit of information of whether price is going to break through something or bounce from it, I'm only going to look at the previous swing. The information I get from two swings over is relevant only in providing significance to the level that I want to look at on this swing. So price recency is the next important thing, because otherwise you could just be marking demand zones and supply zones from all over the place. This also brings about the point of first time back and second time back. If the level has not been touched yet and you are seeing price come back to it for the first time, i.e. first time back, then you must assume that there could be $200 or $300 million left of unfilled orders at this level. And since there is weak selling into that level, that $300 million could bounce price and bring in new buyers. If it comes back after that bounce, those buyers aren't found, and price again tests that level, there's going to be fewer orders at that level resting, meaning that it's less likely to bounce. It may bounce, but not as high as before, or it just may completely nuke through that level. So that kind of rounds up my point of fresh orders. So just to summarize, we're only looking at the most recent swing where a demand zone or a supply zone hasn't yet been tested. That's where we're going to get the best reactions from. Okay, third and final point is the significance of the level. And this is the main point of the video. The previous 2 points were leading up to this one, and we have to get a bit of context to understand why levels are significant. We understand what the basics of supply and demand are and the logic behind it. Secondly, we understand we're only looking at fresh orders in the most recent swing across. But how do we know what levels are important and what levels aren't? Whenever you go online, you hear people talking about key levels and pivots and all this kind of stuff. What they mean is an area where there's been key buying or key selling that's taken place, which has broken through a previous resistance point. Now that's important because let's say you've got an area of demand here coming up to an area of supply. If price breaks through that supply zone, it could trigger another sell-off. But if it doesn't, if it pushes up, consolidates again, and then continues up the trend, we know that that level had a huge amount of buying, not only to continue the trend, but also to break through a point of resistance. So if we look at a demand zone that has formed and buying that's taken place that's broken through a resistance level, it is saying to us that there are a lot of buys coming from this point, not only to break through the consolidation it had and continue a trend from there, but to break through a previous resistance where there are a huge amount of sells. You would expect at that point where there are the sellers for price to drop, but it doesn't. So if you've got a continuation then, price moves up, consolidates, and then pushes back up again, you would expect the most recent demand zone, i.e. the demand zone that has just formed and broken out, on a retest to bounce price. And in some market conditions, it will. In most market conditions, particularly on forex these days, price is going to retrace to a key level. These key levels are the levels that form prior to a break of resistance if you're going long, or prior to a break of support if you're going short. So when you're looking at levels to trade from a supply and demand perspective, what you want to look for isn't just any old area of consolidation, because they may not have significance. You may just see a little cluster form in the middle of a swing that hasn't taken out any previous levels of resistance, where it's basically just people maybe taking profit, will look to take trades at areas where prices consolidated prior to breaking another level. And really, that's just what I look at to trade from. I found that they're super powerful. In the right market conditions, like I said, you will get quicker trend continuations, but it always pays to wait for these key decision points, because even if price doesn't bounce from them and it breaks it, you can then flip your directional bias to look for a new trend. Because if those levels are broken, those key decision points that have broken other key decision points or areas of demand and supply, you know there's going to be a reaction there, and that's going to be the best place for you to put some risk. So to summarize, because it is quite a simple thing, really you're understanding the logics of supply and demand trading, which is more buyers than sellers at a certain point, which is denoted by an equilibrium, aka a range, a consolidation period, a base, a bull flag. You're understanding that there are fresh orders at that level where you can expect a reaction. When it's been tested several times, there's going to be less likely of a scenario where you can expect a bounce. And obviously, if you're looking for a continuation, you can wait for a relief of that bounce. Thirdly, you're going to be trading at levels which are significant for a reason. And that reason is that it's broken a previous key level. And that key level is always where a decision was made to break a previous support or resistance point. That could be at a high, it could be at a low, it could be another decision point that price is broken. There are certain things when you pick up supply and demand trading where you just end up looking at every consolidated area as a supply or demand, aka if it's a supply you have to go short, if it's a demand you have to go long. If it's a demand zone, I went long on it and it didn't work, well, it could be for the reason that it's not an important level. And this method is a way just to pick out key levels. Sometimes you're gonna have to be pretty patient for them to come. Price may be floating around in the middle of nowhere and can turn on a dime. It can flip for absolutely no reason whatsoever. So it's always best to wait for these levels. And if you're coming to the chart and you can see that there's nothing on, the best thing you can do is mark the closest key supply zone and the closest key demand zone, and then just wait to see what happens. You can set an alert there and then you can wait for the trade to happen, or you can just set an order there, depends on what's happening. Obviously it's best to trade with the trend, but that's for a different video. So I wanted to keep this short and sweet and just basically lay out the really simple idea for anyone to get and apply to their own trading. If you've got any questions, put it in the comments below and I'll happily get to it and make another video. These are just little nuances I've picked up over the years. And if you're looking for a way to trade these levels, then check this video out. Thank you.